Monthly Market Report for November 2024. Market movements. The VN Index closed November with 1.1% month-on-month decline, mainly due to a 4.7% drop during the first 2 weeks. This was driven by concerns over a stronger US dollar and potential devaluation of the Vietnamese dong by year-end. Foreign investors continue as net sellers, with a total net selling value of $468 million in November, an increase of 18% compared to October's $395 million. In the second half of the month, the market showed signs of recovery, boosted by optimism around proposed changes to property market regulations, an extension of the value-added tax (VAT) cut through mid-2025, and the introduction of a 5% VAT on fertilizers to support producers. Investors were also encouraged by the Prime Minister's ambitious target of 8% GDP growth for 2025, focusing on domestic growth drivers like public investments and a rebound in the real estate market. This exceeds the National Assembly's official target of 6.5 to 7%. Additionally, the November Manufacturing Purchasing Managers Index, or PMI, showed continued improvement, reaching 50.8, following 51.2 in October. Sector performance. In November, sector performance varied, with strong gains in IT and industrials. On the other hand, the index faced pressure from declines in consumer discretionary, energy, and financials. The IT sector was up 6.1% month-on-month, benefited from FPT's partnership with Chinese tech firm Yongyu to expand management software solutions across Vietnam and Southeast Asia. Industrial saw a 3.1% month-on-month growth as Viettel Post began operating its B2B smart border logistic project in Lang Son province, supported by a 144-hectare leased facility with a total investment of 3.3 trillion Vietnam dong. On the other hand, consumer discretionary was down 4.3% month-on-month and struggled due to a decline in Mobile World Investment Corporation (MWG) shares, reflecting investor concerns about slow consumption recovery. Energy was down 3.5% month-on-month and faced challenges from weak Brent crude prices, driven by lower demand from China and uncertainty over potential Federal Reserve's rate cuts. Meanwhile, financials dropped 2.2% month-on-month as rising interbank interest rates and a record high exchange rate fuel worries about tighter monetary policy and reduced capital inflows. Macro review. Beginning with GDP growth and key sectors, in November, the industrial production increased by 8.9% year-over-year in November and by 8.4% year-to-date. This growth was supported by resilient manufacturing, which grew 9.7% year-over-year, highlighting a steady recovery following Typhoon Yagi and consistent production activity. Retail sales grew 8.8% year-over-year in November and maintained the same growth year-to-date, showcasing strong domestic consumption. When adjusted for price factors, retail growth was 5.8% year-to-date. Tourism-related sectors such as accommodation, which rose 13% year-over-year, and catering, up 17.3% year-over-year, were a major contributor to this performance. For the Consumer Price Index, or CPI, the overall CPI increased by 0.13% month-over-month and 2.77% year-over-year in November, staying stable. The average CPI for the first 11 months of 2024 was 3.69% year-over-year, in line with inflation management targets. The core CPI rose by 2.7% year-over-year in November, similar to the figure in October. Food prices remained steady, while energy costs saw moderate increases. The controlled inflation environment helps maintain consumer confidence. In terms of trade balance, exports in November totaled $33.73 billion, a decrease of 5.3% month-over-month, but an increase of 8.2% year-over-year. Imports reached $32.67 billion, down by 2.8% month-over-month, but up by 9.8% year-over-year. This resulted in a trade surplus of $1.06 billion. The narrowing surplus was due to a slower pace in mobile phone exports and an increase in machinery imports. For the year-to-date trade surplus, it accumulated to $24.31 billion, reflecting a 4.3% increase year-over-year. The surplus was supported by strong growth in both capital goods imports, up 16.4% year-over-year, and exports, which grew by 14.4% year-over-year. For foreign direct investment, or FDI, registered FDI reached $3.74 billion in November, bringing the year-to-date total to $27.3 billion, a 19.4% increase year-over-year. The spurred FDI totaled $2.1 billion in November and $21.7 billion year-to-date, marking the highest disbursement since 2012, with a 7.1% increase year-over-year. Newly registered FDI grew by 1% year-over-year to $31.4 billion in first 11 months of 2024, with Singapore leading at 29%, followed by South Korea at 12%, China at 12%, and Hong Kong at 12%. Public investment disbursement reached 60.7% of the annual plan, highlighting challenges in meeting the targeted spending rates. Market view. The market outlook has become more positive, driven by both domestic and global factors. The National Assembly's broad resolutions, such as pilot housing schemes, an extension of the VAT cut until mid-2025, and approvals for capital-raising plans from Vietcombank and Vietnam Airlines are acting as strong drivers for key sectors like real estate, banking, and aviation. The foreign exchange situation has improved, with USD to VND rate stabilizing and interbank rates easing, which helps reduce concerns about rising interest rates. On top of that, the Federal Reserve's expected rate cut in December, with a 65% chance, is providing strong support for the Vietnamese market. We are also encouraged by speeding up of government reforms led by the Secretary General, which is boosting optimism. In the business community, we expect to see positive economic outcomes beginning in 2025. That concluded our market report for November 2024. Thank you for your attention and stay tuned for more updates.